Oliver, each new copy of the Financial Times reminds us that markets are overvalued. The pundits warn us day after day. If this is true, surely now is the wrong time to own an asset manager, which is a levered play on these overvalued markets. I'm thinking here of Henderson, a UK asset manager that is so giddy it's actually making acquisitions.
It is indeed. Henderson has today announced a couple of acquisitions, fairly small acquisitions in Australia. And you're right, it's very easy to think that as a geared play on the markets in which it invests, Henderson might not be great right now. Equities look expensive. Henderson's shares also at 17 times forecast earnings. You look at the sort of 5-year average, that's closer to 13 times. So
it's an expensive play on an expensive market.
Yeah. That's one way of looking at it. On the other hand, you can look at what Henderson's doing and where the strategy is taking the group. As I say, it's made these couple of acquisitions in Australia, and the idea is to increase its presence in Australia. Why that's a good market is that Australia is a very big savings market. There is a compulsory pension savings scheme there, which means a lot of assets, a lot of money goes into savings. There's a lot of money there to be managed. So Henderson is trying to diversify its exposure, increasing its presence in Australia. Previously, it's increased its presence in the US, and generally diversifying away from the UK.
So the question, it seems to me, still remains, though. Global markets are increasingly correlated and so forth. You know, if there's turbulence as we head into the possibility of increased interest rates and the accompanying tensions, isn't this not the kind of stock we're going to want to own?
I think it's inevitable that when markets turn, the shares of asset managers will also turn. I think there's no getting away from that. But it depends on the asset manager themselves and how they're made up, exactly how much they will be affected by that. What Henderson is trying to do is to diversify globally and across different asset classes, and these acquisitions are part of that. Other asset managers have stayed very focused on one market, and if that market goes wrong, well, they will be very, very heavily exposed. But most asset managers now are trying to diversify in all kinds of different ways to provide some level of cushion. Now, if all markets turn at the same time, of course, they'll all be hit. But if it's slightly more nuanced than that, and some markets are worse than others, then the more diversified fund managers will have more protection.
I guess we could put my same question in a more pointed way, though, which is why invest in an active manager? We live in the age of the ETF and other passive products that just track markets, which have been doing very nicely, thank you. Why get involved in an active manager at this point?
Well, the theory that the rise of very big passive managers and very small specialized, very active managers will leave no space for the sort of mid-range ones in the middle. That idea is, in theory, a very attractive one. It doesn't seem to be playing out, though. That a lot of the mid-range names, you think of UK-listed Jupiter and Henderson and a little bigger as Schroders, they all seem to be doing quite well. You look at this year, markets have been broadly flat this year, but Henderson has been able to increase the amount of new money it's brought in from outsiders. So people are still putting their money into active managers, regardless of this theory. And so as long as customers keep giving their money to these firms, they'll continue to thrive.
Thanks, Oliver.